here, and I'm looking forward to the session.
Good afternoon. It's good to have you. So we were just saying, given your experience and the fact that you've been able to build a successful tech business, but it didn't just start that way. You had an idea that you had to birth, you had an idea that you had to fund. So we'd just like to know, what was your experience? What do you have to say to other tech founders in terms of funding?
Are we diving straight into the session? I thought you wanted to introduce everybody first.
No, we just gave, we'll be introducing as we go along. So we'll just dive right into the session. Thank you.
Okay, absolutely. For some reason, my intention is always the best connection. For some reason, it's a bit shaky this afternoon. So I'm going to stay on audio for most of the session and go on video when I can. I think I'm not, like I mentioned before, I'm not the, how do I put this? I'm not the expert when it comes to fundraising per se. Otherwise maybe, would have raised tens of millions of dollars, but we haven't. However, we're grateful for where we are. And I think for me, the secrets to any successful business, either you are seeking capital or you are not, is, what I like to call your economics, your numbers, right? If it makes sense for anybody to put their money in your business because they see the returns down the line, they will put the money in your business. So I think for me, the primary thing to factor in trying to fundraise is my business at the point where I'm confident that we can, number one, generate significant amount of revenue, and number two, do I understand the nitty-gritty detail of managing and returning value to investors? So those, for me, I realize are the two most important ingredients to running a venture-backed business. It's a different type of business. Chinonye, are you here? Can everybody hear me continuously?
Yes,
okay,
I am.
fantastic.
We can hear you clearly.
Fantastic. Okay, if you can stay on me, if you can stay, audible, so that I can always check my connection with you as we go. I will try video from time to time, but when video, messes up, I will go back to just a normal audio connection. So I think when it comes to anything related to funding or fundraising in any form, debt or equity, those are the two big questions that everybody needs to ask themselves. Those are the two questions I ask myself every day. And these are the questions that I see a lot of people ask themselves, things that I've seen, friends of mine that are doing, some of them now doing very well, ask themselves. But before we dive into those two things, and I wanted to just, do this intro and then let you continue and then maybe ask more questions. I want us to remember that there are three types of businesses or small businesses, the way I like to put them. Okay, maybe there are two types of businesses generally. There are small businesses and there are big businesses. And your small business can be a personal business. You're self-employed, you're a doctor, or you're a carpenter, and you do your practice by yourself, what you call private practice. Some people say PP, self-employed. And that's just one type of small business. But I'm talking about the three classical types of small business, the way I like to put it. You have the small and, your traditional small business. That's, the one you grow, and maybe it can become a multi-billionaire business. Still a small business. And there is what you call you can call that the classical SME. And there's what you call the SGB, that's the small and growing businesses. Those are businesses that are designed to grow very rapidly. They can attract, debt funding from banks and things like that. And then you have the third category, which is what we all now know as startups. They're also small businesses, but they grow using a special type of fuel. They don't, it's like sunlight plus some special steroid. Like every other plant will use sunlight. But the startup small business uses the natural sunlight, but with some special ingredients. That special ingredient is called venture capital. The way people miss it is thinking that the venture capital is for everybody. It's not for everybody. It's a special ingredient. And only 5% of companies ever really grow using venture capital. Only 5%, maybe less in some instances. And it's easy to know that how many fintech companies have been funded venture capital in Nigeria. You know, the best report out there say there are about 200 to 250 fintech companies in Nigeria. How many do you know that have successfully raised any significant amount of funding? Maybe $500,000 or $1 million and above. Maybe 10, maybe 20, right? 10% or less. So I think for me, I'd love us to go into the nitty-gritty details of what type of business are you trying to build? Do you understand the type of business? And then what type of capital, you know, what you call funding, strategies for funding tech businesses. So I would say call it strategy for funding. Okay, well, funding or capital, what type of funding or capital can you attract and how? And the peculiarities of both. I think during this session, we'll go into some of those details. Unfortunately, I won't be using any deck. I think that's actually going to make it a bit easier for me. For example, we're planning to raise a few $1 million in equity, but we're doing almost $10 million in debt as a business, right? It doesn't sound traditional. Even me, I'm scared. You know, throw people's money away and all that. But of course, it's a very difficult process, but something that is achievable if you put the right measures in place. So I think I'll stop there for now and let you, you know.
The plan was actually to take questions at the end, but we can see a number of questions from my Instagram already. And one is just in relation to you specifically, what were the things that you saw that made you know that you were ready to expand as a business in the early stages? So that's just a question that we have on our Instagram. And I think that would be something that we can just take quickly as opposed to waiting for the end.
Yeah, absolutely. Okay, so I mean, I think maybe what my confusion is, Chinonye, is I was hoping that the founder's experience. Okay, the first 25 minutes. Okay, understood. Okay, gotcha. Okay, all right. So let me just you know, in that sense, use the opportunity to run through sort of my entire conversation and then you know, take it as we proceed. So you said the question was what again? Tell me the question again.
The question was for you, when did you know that it was ready for you to expand? So in the early stages, when did you know that it was ready to expand and what were the things that you considered? I think you've kind of answered this a bit, but just for more personally.
Yeah, okay. So, I mean, I think let's start this way. Sometimes it's not necessarily as clear in terms of what type of business am I building and, you know, what type of capital do I need and when do I need to raise this capital. The other thing is, like I said, if you have identified the type of business that you are building, and one is not necessarily better than the other, in my view. Okay. How do I put this? You have people who are doing businesses that are like surefire path to wealth creation. And they're extremely small businesses. These are businesses where the founder, maybe a small team, 10, 20 people. And a lot of the time, I'm really very happy for the kind of experiences that I've, or the kind of things that have happened to me, the kind of scenarios that I'm about to confront. Pretty much in the last 10, 12, 15 years. Now, Tina, I'm finding a way not to disappoint your audience, right? By the things that I want to say. I'm finding a way to say that let's stop this, is it infatuation or this sexiness of I want to go and build a fintech startup. Sexy. It's not bad, but it's like putting all your eggs in one basket. So I think everybody needs to step back and ask yourself a personal question. What do I really want? Now, I know a few businesses I personally know, not that I'm aware of, like I have my money in a few businesses, like my wife's business, like a couple of friends' business, that save every year sustainably a few millions, their own money. No investor, no pressure from anybody for end of the year numbers.
Yes.
If you start that kind of business when you're, say, 23 or 25, by the time you're 35, you own a house in Lekki, you're married with kids, your children can go to a nice school, everything is fine. There's absolutely nothing wrong with aspiring for that type of business. In fact, I think that most economies are built on those type of businesses. But there's a lot of sexiness and glamour attached to, you see a lot of founders in Silicon Valley and, newspaper and TV, and it all looks, two-faced, Libya, whiskey kind of, life. But only 5% of people that attempt that achieve it. So that's why I'm being careful to say, first, you need to find out for yourself, what am I really trying to do? What do I really want? When you've discovered that and you've narrowed down the type of business you want to build, because what you really want will express itself one way or the other. Number one, either because you will not have the energy to push the madness required to build a venture capital business. Most people cannot do it. The madness required to do a venture capital funded business, most people cannot do it. Now, of the 5% that get funded, the people that are funding those 5% expect maybe only 2 out of 10 to succeed. So effectively, there are 100 businesses out there chasing venture capital, but only 2 really matter.
Okay.
So my argument is, when you're thinking about tech, business, startup, funding, whatever it is, think in 2 dimensions. First dimension, what can I do? Maybe you even run 2 parallel strategies. What can I do to make sure that come rain, come whatever, this business will succeed by my brutal effort? Maybe you need a few million, maybe 5 million, maybe 10 million to build that kind of business. For example, today, agency banking business, 5-10 million, you'll be doing, you'll be able to save a few millions a year, uncontested, not money to be declared as dividends to investors somewhere down the line, or you have to go and chase how to IPO, or you have to go and find someone to buy your business so that you can give your X returns to your investors. So let's take that out of the way. I've clearly said now that you need to assess what your personal goals are and what your strategy is to achieving those goals. Once that is clear, now let's assume that you truly want to do a venture capital-based business, and you are truly defined as a venture capital-based business. Number one, you need to be able to grow at an astronomical rate. There's no other way. Venture capital is designed that in 10 years, typically 7 to 10 years, maybe 15 at the worst case scenario, you are a huge business, hundreds of millions of dollars or billions of dollars. Maybe even let's say $100 million for an African standpoint. First question you need to ask yourself as the person building that business is, do I have a roadmap that will get me to become a $100 million business? For example, if the answer is yes, when I say roadmap, the people, the talent, the skill, the experience, the understanding of how venture capital is run. If you have that and you're convinced you have it, which is very good, talk to mentors, go into startup ecosystem. Nest seems to have a lot of consistency. They're based in Ghana. Action Venture Builder, something like that. Action Venture Lab or something like that is also a very good one. I know Greenhouse, which I was part of Class 1, also seem to have some type of strength. A number of CC Orb, these are some of my investors as well. They have that structure to help guide you through a trial, and a trial is always good. But let's not get broken that I couldn't raise $1 million, I couldn't raise $5 million, so I'm not worried. No. Now
I
that
think
that's
you
out of the
raised
way.
something very important, which is know what suits your business and know from the beginning what you need to do, how much you need to get, and what to focus on. And also don't be broken down if you can't, raise what exactly you set out to raise. So sorry, but this is so exciting and we're already running short on time, and then we have so many questions for you. Apologies if we're not able to take all of them, but we'll get back to some of the questions we have from listeners to you right at the end. I think there's so much that everyone wants to know. So just tying into what you said about knowing exactly what you want for your business and what steps to take for your business, I think that's what our next speaker is really going to delve into. So we have Mr. Adetomi, and he's a co-founder of eFinance Limited, a financial technology solution that provides a wide range of consumer finance products, specifically investments and short-term loans to income earners, previous to which he headed the conglomerate and corporate banking group of a leading commercial bank in Nigeria. He has over 20 years experience working in financial services and the public sector. His wealth of experience covers public sector finance, corporate banking, commercial banking, and corporate finance, while his role primarily involved debt finance and financial advisory services to a wide range of other businesses. He has also assisted several startups in the fintech space by providing advisory for debt and equity raises, valuation, and strategy. He has an MBA in finance from the Durham Business School and is a certified member of the International Institute of Certified Forensic Accountants. So we're really pleased to have you. This is someone who has a lot of finance experience, but is also a business founder. Thank you so much, Mr. Odufuye. We're looking forward to hearing what you have to say.
Okay, thank you very much, Chinonye. Can you hear me?
Yes, we can hear you.
Okay, well, thank you for your very generous introduction. I actually thought you were talking about somebody else. I want to thank you thank the organizers of this webinar for the opportunity to share my experience and perspective on funding tech businesses. I think we've had a very engaging session. Mr. Salami spoke to some very, very interesting points. But I'd like to share my perspective, both as a founder, raising funds to start and scale a tech business, and also a financier from a transaction advisor's perspective. So basically, we're talking about how to raise capital. Now, if you go to the next slide, we're talking about debt or equity for tech startups, how to identify the right funding mix to start to set up and to scale a business, the funding options available, when to borrow, when to sell. So I'll be sharing my perspective on raising funds for a tech startup, some of the things that we've learned along the way. And I thought I would start by sharing our story. Now, if you go to the next slide. So a few years ago, a couple of gentlemen in a men's fellowship agreed to pledge about 100,000 naira just to support small businesses at a local church. So if you go to the next slide, you just see the highlights of what we've been able to do. So basically what we did was we just started by obtaining a state lender's license, which cost about 400,000 naira. And we started by offering loans on an online platform. Basically, we were a digital platform, low-cost platform. Between January of 2017 to July of 2020, we were able to disburse about close to $2.6 million to loans to SMEs and salary earners in paid employment. Now, this was basically funded through equity, through debt, and shareholder loans. We also heavily invested, and we continue to reinvest in our digital architecture and our IT infrastructure. So presently, we are transitioning to a CBN licensed finance company. And I think this also gives us the opportunity to scale and to offer a wider range of credit and investment products. And our goal and our aim is to disburse loans to about 10% of 37 million SMEs by 2022. We are currently raising a little bit more capital, mostly debt and equity, through private equity investments, shareholder loans, and locally sourced debt notes. And also, we're also looking at planning to raise additional capital and to grow our loan book, and also to optimize on technology. So I think the next slide just speaks basically to some information about the kind of products that we offer. And I would like to take time to share some of the things that we learned along the way. But before we go into that, I think it's important for us to even dimension the tech space. So if you go to the next slide, there are so many opportunities available in tech today. There are a wide range of business opportunities, but at the core of every business, or every business exists to solve a problem. So we have companies providing financial services solutions, from lending, payment solutions, crowdfunding, credit scoring, robo-advisory, big data, Internet of Things, savings, investments, insurance, digital currency, Bitcoin, pensions. We also have tech companies offering solutions around agri-technology. Agri-tech, telemedicine is also very big now. Biotechnology, robotics, artificial intelligence, e-commerce solutions, logistics, gaming, sports betting is also something that is currently big now in tech. So there are a wide range of other businesses with models basically built around using innovation and technology to solve problems through digital platforms, either as an app or through a web. And we've seen companies like Lyft, Uber, Airbnb, Snapchat, and a wide range of other companies that are causing disruption to conventional markets. Now, in starting any business, and if you go to the next slide, there are many opportunities around tech to build a business that solves problems. But in funding your business, if you are talking to a financier or investor, there are three simple things that you need to be able to answer. And the first thing is, what problem are you solving and how do you intend to solve it? As basic as that. You know, a lot of people, when they are thinking about starting a business, they come up with a 48-page business plan, you know, financial models, revenue is always up, expenses are always low. But basically, the conversation should be exactly what you want to do. And it can be like, you want to address the issue of financial inclusion, and you have developed an app or a mobile wallet that allows people in rural areas to save. So that's the problem that you want to solve. The second question you need to answer is, what is the proof? So if you started maybe 3 or 4 months ago, you invested a little bit of your savings, and you already have about 300 subscribers, I mean, that is proof that your test case works. And the third question you need to answer to an investor or a financier is, why you? Now, why you means your story, your personal brand, what have you done before, where have you worked, what have you learned, who have you worked with, what are your references, and what is your stake in the business? So for me, in a nutshell, those are the three things that you need to be able to answer. Now, on the next stage, I just tried to give us a sense of the different stages in every business. So you start from seed or inception stage, and you evolve, you know, to growth, to maturity, and then to exit. Now, in this part of the world, when people want to start a business, the first thing that most people think about is a bank loan. Now, the truth is that you are looking for the right product, which is capital, but you are going to the wrong institution. So I worked in a commercial bank or in corporate finance for a commercial banking in a commercial banking perspective for many, many years. And I saw this all the time. So at the early stage of your business, even if you're able to get a bank loan, one, it's expensive. And two, your business at the inception or idea stage might not be generating the kind of cash flows that you need. So at seed stage, it's extremely difficult to get people to invest in your business. If you're lucky, you might get an angel investor that might have an idea or understand your business plan. But there's an issue between you can have a business plan or have an idea, but execution is what matters the most. So what do you do? How do you start at the idea stage? Now, there are several things you can consider. Now, for a tech business, you might be able to get a grant if you're doing something that has to do with in the medical space. There are a lot of companies that are investing in R&D, but the best place to start is to start with your money and to bootstrap. I always tell this story. Now, if you want to start a chicken farm, you don't go out and buy a large expanse of land and hire people and buy trucks. You start by buying a crate of eggs. You sell a crate of eggs, you buy 6 crates of eggs. You sell 6 crates of eggs, you buy 10 chickens, and then you scale gradually. And also that gives the idea, that gives you the chance to show people, to prove your test case. Another thing you can do is to look for partners, and you can pull funds together. So look for people, maybe people that you work with, and then you can all put money together and start a business. But it's also important to have a shareholders agreement. I think we have a lawyer on this call, so it's good to document everything at the inception so that you don't run into trouble down the line. But if you're lucky, maybe you might find an angel investor. I know that there are some angel investors. If you do your research, there's a Lagos angel investor, and there are actually people now that have money that are looking for returns. Crowdfunding for a startup, I haven't seen a lot of success in that area, but that is something that you can also consider. For me, the most viable source for a startup is what I call the 4 Fs: friends, family, founders, and fans. Not fools, but people that believe in you, your co-workers, your former bosses, people you have interacted with, people within your network. So from growth stage to established stage, then you can also start looking at VCs. And I think somebody alluded to the opportunities available for VCs. So, but what are venture capitalists really? So I think venture capitalists, they aim to identify, to fund, and promise and profit from promising early stage companies. So they raise money from institutions and wealthy people, and they pull it into a fund, and they invest in technology companies that they will believe they will become more valuable. So they start with seed funding, and then you can have several rounds of funding from Series A to Series B to Series C. Now, VC funding is not cheap, but is extremely patient. You can basically have that money forever. But most investors are looking at making 2 or 3 times the amount of their capital that they've invested. Private equity is another option at the growth stage, which is basically an alternative investment class. It comprises of funds from investors that invest directly in companies. And so this is another option that you might want to consider. So the VC and private equity market in Nigeria is still evolving, but if you look at other markets in the United States, about 8,300 companies across the country receive venture funding for their businesses. So you have about 1,000 VC firms managing almost 2,000 active venture funds with about $400 billion in capital. And I think I'll spend some time looking at the size of the VC market here in Nigeria compared to other markets. So at the early growth stage of your business, as you evolve, you might then consider a bank loan as your cash flow improves. So if you want to acquire an asset or if you want to invest in new technology, then you can look at a bank loan if your cash flow can support it. There are so many peer-to-peer platforms now, especially for agri technology, that links lenders to borrowers. So that is something that you might want to consider. But one thing you need to think about is when you start to take money from VCs or from high net worth individuals or from major investors, is that you might need to cede control of your business. You might need to give them a stake of your business. If somebody is going to invest even 1 million naira, they can insist that, okay, I want to be on the board, and then you have to put in corporate governance policies in place, and there may be issues of conflicting interests. So these are things that you might want to consider. Now, if you don't want to dilute your shareholding, if you want to keep all the equity for yourself, you can offer debt to investors, and you tell them, hey, I will start with a loan, which can be converted to equity at an agreed price, further down the line. And I'll talk a little bit about some valuation models down the line. Another option is that you can also sell your shares to someone with the understanding that you can buy back those shares at a later date. So if you sell 20% of your business and you take 1 million naira from somebody, you can tell the person that, look, as over the next 5 years, as I pay you back, I'm going to buy back my shares. So you can have a good lawyer that can basically draft a proper legal agreement. So from maturity to exit stage, now there are different options you can consider at this stage in your business. Your business has evolved, you have a little bit of cash. So you can fund your business from your cash flow. You can do an additional equity raise. You can raise bonds or commercial paper. And at this stage, you'll probably be able to negotiate long-term single-digit financing. There's so many intervention funds available by the CBN and a wide range of other investment products. Now at exit stage, then this is the opportunity to sell. And some people might ask, well, I don't want to sell. You know, we have founders like Apple, Facebook, Amazon, where the founders are still in the business. But I mean, we have other companies like PayPal and Elon Musk. Elon Musk, after he decided to sell PayPal, and he went on and invested in Tesla, SpaceX, you know, and a wide range of other businesses. So that's an opportunity. So at exit stage, you can decide to sell. So earlier on, I spoke about VC funding. So if you go to the next slide, just to give us a sense of VC funding, the opportunity, and the gap. Now, the total amount of money invested by VCs in the United States, Europe, and China was about $80 to $173 billion in about 7,500 deals in 2008 and 2019. Now, this includes Ant Financial, which is the financial arm of Alibaba. They raised about $14 billion. SoftBank raised about $3 billion for WeWork. And ByteDance, the people that made TikTok, they raised about $3 billion. So in developed markets, there's a large pool of capital in developed markets. Now, if you compare that to the total amount raised by African startups in the tech space, if you go to the next slide, depending on the different data sources, the ranges were from about, I think, 455 million to about 1.8 billion, which now this represents about 2.6% of the money that was raised by US, and 9% of what was raised by China, and 14% by Europe. So if you look about in Nigeria, about between 120 million, depending on the data source, to $700 million was raised by VCs and by startups. Now, I just want to take time to highlight some VC transactions in Nigeria, just to give us a sense of the possibilities and the opportunities that exist for access to capital. And I know we have many successful entrepreneurs on this call, and I look forward to hearing and learning from you, but I just want to share some transactions. So if you go to the next slide, just a few transactions. Now, PiggyVest is a company that we know, and I think what really inspires me about this company is that it was started by a couple of young guys straight out of college. It's a phenomenal story. So I think it's an online savings startup founded in 2016, basically to help millennials invest and save for the future. It also has a platform that offers foreign currency investments and alternative investments in agriculture. Now, they were able to raise $1.2 billion in seed funding, and I think that's a phenomenal story. Now, there's another company which I find very interesting. It's called Cobot 360. They're based in Nigeria, Kenya, Ghana, and Togo. So it's a tech startup. It's founded in 2017, and it basically provides a marketplace for shippers and transporters. It's a logistics solution that aggregates a fleet of over 17,000 drivers. So they raised about $20 million in equity in Series A funding from Goldman Sachs and $10 million in debt from local banks. So they raised a total of about $37.3 million since they started. Another interesting story is Max.ng. So they were founded in 2015, and they began as a delivery service and basically evolved into an on-demand motorcycle taxi hailing platform. Now, they raised about $7 million through Series A funding, and I think in total they raised about $8.5 million since inception. Another interesting story is Jumia. So Jumia raised a fair amount of capital, basically through VC-backed deals over the years, and they were once valued about over $1 billion. Now, there has been a bit of bad news since the IPO, but we need to give them credit for being a company that made people really believe that e-commerce is possible in Africa.
No, they're back up, Tommy. They're back up now, actually. They climbed back up to over $1 billion a couple of weeks ago. So
excellent.
Yeah.
Yeah, okay. So it's not all bad news after all. So now,
yeah.
in your bid to raise capital, So people always ask, so how do I value my business? So if somebody comes and says, I want to put $10 million in your 10 million naira or 1 million naira in your business, what percentage of a business should you own? So if you go to the next slide, there are several kinds of valuation techniques. On the next slide, you have the DCF valuation, which is most popular valuation. You have the comparable company analysis, which looks like trading multiples or multiples of earnings before interest, tax, and depreciation of similar companies. Then you have the precedent analysis. So it compares the company in questions to other businesses sold. So let me just to talk briefly about the DCF valuation, which is the most common kind of valuation. And if you pick up a corporate finance textbook or even go to YouTube, it basically explains how it works. So it's on the next slide. So basically, your DCF valuation, it values all the revenue that your business, it tries to estimate the present value of all the future value that your company will make in perpetuity. Now, so if you have a company that you have run for 3 years and you have proper audited accounts, so you have your profit, so you have your revenue, the cost of generating that revenue, you get your gross profits. Now you take away your selling and general expenses, you get earnings before interest, tax, depreciation, and amortization. Once you make the necessary adjustments, you get the free cash flow. Now, based on how your company has been growing previously, you can now say, okay, in the first 3 years, I have grown by X%. I am believing that in the next 10 years, this is how my company is going to grow. So you get your enterprise value, and then you discount that by your company's weighted average cost of capital, which is your cost of equity, your cost of debt. You have to make adjustments for beta, for the market risk. It's not really complicated anyway. If you just take your time and look at it, it's something that you can estimate. So let us assume that you do this exercise and your company is worth, your enterprise value is 25 million naira. You have 5 million shares. So your company is worth 5 naira a share, okay? So if somebody comes and says, okay, I want to invest 5 million naira in your business. So at a 25 million naira valuation, the person is saying that he wants to invest 20%, he wants to get 20% of your business. So basically that is how a DCF valuation works. Now there's a problem with valuation, because the problem with valuation is that it makes a lot of assumptions, and it assumes it's a bit subjective, because it assumes what's your business, what the potential of your company. And I want to share 2 stories. In 2006, Yahoo offered to buy Facebook for $1 billion. Now people thought that was ridiculous because Facebook was a 24-month-old company, had only 8 to 9 million users and total revenue of $12 million. And people thought that valuation was overvalued. But the next year, it was valued at $15 billion. In 2012, Facebook IPO'd at $100 billion. And it has a current valuation, as of the time that I did this report, of over $682 billion. So you can see that valuation is extremely subjective. Now imagine if Zuckerberg has sold Facebook for $1 billion. Another example is here in Nigeria. So in 2001, Nigeria had less than 500,000 landlines, mostly analog lines. There were few digital lines, and if you remember, making an international call was terrible. There were 3 Nitel offices where you could go to, and you had to queue for hours before you could make an international call. So MTN came into Nigeria, and they offered some people, they came and they asked some people to come and invest. And in their projections, they said they will break even by year 7, and they will have 2 million lines in the first 2 to 3 years. And people were very skeptical that then there are only 500,000 lines. Nitel had operated for many years. People are skeptical. There's no power in Nigeria. People really didn't believe. MTN launched on the 16th of May, 2001. I remember I was a youth corper then. I used my youth corper salary to buy a SIM card. A SIM card was 30,000 naira. A Motorola phone was 36,000 naira. And people were saying, poor people won't be able to afford these lines. By December of that year, they had 3 million subscribers, and MTN broke even in 1 year. At the time of the IPO, they had a valuation of $1.8 billion in 6 months. So as you can see, valuation is extremely subjective. Now, as I begin to round up, if you go to the final slide, just some things that we need to consider as you build your business and as you look for options to raise capital. Few things you need to consider as you go along. The first thing that I would advise is ensure you have up-to-date records and documentation. Make sure you have, even if you are a one-man business, make sure you have audited accounts and they are up to date. If you have invented a new technology, make sure you patent your idea to protect your intellectual property. Make sure you're up to date with FIRS, LIRS. Make sure you file your returns with CAC. I think there's a lawyer on this call that can give us more information, because I've seen people that run businesses for years, and then when they get the opportunity, they realize they have a huge tax liability. And if you're also collecting people's data, there are some regulations. There's the Nigeria Data Protection Regulatory Act, which is promoted by the Nigerian Information Technology Development Agency. So you can speak with a lawyer. Now, the truth is that if you cannot afford a lawyer or an accountant, you can barter, right? If you're a website developer, maybe you can offer to build a lawyer's website in exchange for him auditing your accounts. The second point is you need to strive to add value in the early years of your business. Reinvest, keep your costs low, bootstrap, and delay gratification. When you make that first 1 million or 10 million, don't incur unnecessary expenses. You know, there might be that tendency to want to splurge, but the time will come when you will reap the dividends of your equity. The third one is to have a clear goal and a clear path. Now, when we started our business, we knew in 3 years exactly what we wanted to do, and we worked towards that. So you need to ask yourself, what do you want to achieve? What do you want from an investor, even a financial institution? You have to know clearly in your mind what kind of company you want to have. Now, Google's slogan says, do the right thing. And this is embedded in their culture and in their corporate code of conduct. Apple's slogan is think different. And they've been able to create a culture that drives innovation and creativity. Amazon says, work hard, have fun, and make history. And they have created one of the most valuable companies in the world. So I'll say have a clear goal. This will inform the way you operate. It will inform the compositions, the people that you decide to have on your board. It will inform the kind of staff that you hire, to inform your management team, and even the people that you decide to take money from. So finally, be ready and be clear. Think of what kind of company you would like to have and start to operate at that level. Have a culture of excellence. Know everything there is to know about your business and about your industry. They say that success is what happens when preparation meets opportunity. So be prepared and be ready. Be humble so that when that opportunity comes, you can take advantage. So put in the work, believe in yourself, be humble, be honest, be hungry, and most importantly, think big. Thank you very much.
Thank you so much, Mr. Adetomi. So we'll just be moving into our next speaker because of time. So next up, we have Ayobami, and Ayobami is a lawyer with experience in financing. He has advised clients in the financial technology space and provided legal advisory services to technology companies during their funding rounds. He has vast knowledge in litigation and also transactional experience, which helps him provide bespoke solutions that are not only commercially viable, but also effective in mitigating litigation risks for corporate entities. So thank you so much, Ayobami. I'm looking forward to hearing what you have to say.
Thank you, Noya. I'm excited to be here. And so the previous speakers, I like how their sessions went because it kind of gave a background for what I'll be discussing, and it's just perfect. So we're discussing financing options, and there are legal implications for each option you decide to take. And so the previous speaker talked about equity options and debt options, and you need to ask yourself what kind of financing option do you want to take as a founder. And so for debt option, it gives you, I mean, you just get the money, right? You just get the loans, and you don't have to deal with the investors coming in as directors or shareholders of your company, which means you still have control of your company. But then, is that a good idea for a startup, considering that the cash flow is not so big at the moment when you're just starting, and so you might be considering equity finance, an equity finance option, which would not actually have investors come in, and they come in, become shareholders or directors, depending on the. Sorry, I think I have a network issue here. Okay, sorry, just give me a minute. Okay. And so I was saying that you might want to consider equity finance options for a startup. So, I mean, you have to bring in investors, subscribe to your shares, and at the same time have like a certain level of control or influence in the affairs of the company. So it depends on what you want, and like I said, there are legal implications for this. One thing I failed to mention the other time was also a project finance option, and that would speak to getting a loan facility, but I'm trying to give you an example of a structure now. So imagine you have a company, right, and you have a product or a project you want to go into, and so you could create an SPV around that product, like a special purpose vehicle, like a company, a different company around that product. And what that will do is, it's that SPV that will get the loan facility, and then how do you finance the debt you obtain? It's from the proceeds of that particular product or project. So there's minimum recourse or little recourse to the main company. And those are different options that we consider. Nnaji, can you give me the next slide? Okay, so that's just the introductory part. So what I'll be talking about these various options, the regulatory framework around them. I also talk about the kind of agreements you typically enter into. Because of time, I won't be able to go deep into them, but I'll just take one. That will be the share subscription agreement, which is, I feel it's quite common in this space. And so I'll just talk about some clauses in the share subscription agreement, SSA. That's the abbreviation for it. So I'll just talk about the SSA as well. And just read some typical clauses and what you can expect from that as an investor and as a founder as well. Yeah. So I explained what debt finance is already. And for the deal structure around debt finance, you're looking at the facility. Yeah, next slide. You're looking at the facility agreements and you're looking at the security agreements. But I don't want to bore you because these are just legal jargons and all that. So basically, for the facility agreements, you're looking at the loan agreements. Loan agreements talk about the loan you are getting, the facility you are getting, the interest payable on it, the time frame for repayment, and other things like that. The account agreements would necessarily speak to some lenders might want the company to open accounts that they will have be able to monitor, like real-time monitoring. And so where there's a cash flow into the company, there's a revenue into the company, it goes into the collections account, for example, and then there's a debt servicing account where which you can use to service the loan. But so moving on from that, we are looking at the security agreement. So for debt finance, it's possible that you have collateral. You are required to provide collateral. Like it could be a fixed assets, a real asset like a landed property or movable assets. So there are legal implications for some of these things. So for example, you could also create a charge over your shares in a different company. Where you have another company, you create a charge over those shares as collateral or guarantee for the repayment of the loan that you're obtaining. And so where you are I'll just mention this a bit, where you are looking at the deed of share charge that is on the screen now, that's where you're creating a charge over your shares. And one thing you have to pay attention to as a limited liability company is the preemptive rights. So preemptive rights typically are in the articles of limited liability companies, and what they do is they give existing shareholders a right of first refusal on the issuance of any shares in the future. And so so when you're looking at deed of share charge, you have to be sure that the preemptive rights have been waived, because of that, like I said, existing shareholders have rights over that share you are creating a charge on or creating an interest. So as a lender, you are concerned, or as an investor, you are concerned that how do I enforce, in case there's a default, how do I enforce this deed of share charge? There must have been a waiver of the preemptive right so that you can have access to the shares. Something else I'd like to talk about, the security deed. That's if you are creating a charge over real assets like landed properties. And so there are different clauses, but one thing I would like to talk about is the covenant to pay in the security deed. The covenant to pay necessarily gives, just to give a scenario, make it practical now, you could look at where there's a guarantor to your loan. For example, there's someone guaranteeing the payment of that loan, and probably provide the landed property as the guarantee, as the collateral for the loan. And so as a lender, you're asking yourself, okay, where there's a default in the repayment of this loan, I have recourse to the property. I could sell the property and get my loan, my principal and interest back. But what if the property is not sufficient to service the debt or liquidate the debt liability? So you would want to have recourse to the guarantor at times if, in case the borrower is not forthcoming. And so that's, so you need to be careful whether you're on the lender side or the side of the company about the covenant to pay, because what it does is that it gives the lender recourse to the guarantor directly. So yeah, the compliance framework. I was talking about compliance framework. No, the previous slide. So compliance framework. Sorry, just a moment. Yeah. So where there's a charge paid over a landed property, I mean, you have to register at the land registry. Where it's a company that owns the landed property, you have to report that to the CAC as well, and so it will be in the records. When I'm saying CAC, I mean the Corporate Affairs Commission. And for movable properties, there's a National Collateral Registry, and it was created under the STMA and the Secured Transaction in Movable Assets Act. So what that does is that it allows you to register securities created over movable assets, but it's limited in that it's only available to lenders who are financial institutions and not just any lender. And so so what registration, generally what registration of interest does, or when you register the charges you have created over these properties, or whether movable or immovable, what it does is that it gives you preference where there's insolvency, where the company is unable to pay back, and then the company is being wound up, then it gives you preference when it's registered. So it's really important. So the next slide. So I'll just be moving straight to the equity finance options, leaving the debt finance now. So like I said earlier, you have different options, and I like the fact that Tomi talked about the IPO, like you can see as listed, private placement, shareholder rights issues. For all these options, they have legal implications, right? Yeah. So basically, I'll just run through them, talk about legal implications, and then we move on. So for the private placement, it's basically you're just offering you're issuing shares to private individuals, not to the public per se, but to private individuals. And for the IPO and SPO, it's IPO means initial public offering, and SPO is subsequent public offering. These are usually from companies that are going public. And I think I won't talk about that too much because I mean IPO are for public companies, like I said, and it's the tech space doesn't really have PLCs. So I won't really talk too much on that. So I'll go to the next one, which is the shareholder rights issue. Tomi talked about this. And so what the shareholder rights issue does is that it allows you to raise funds, additional funding, additional capital from your shareholders, existing shareholders. And this is a good way, instead of going around and trying to get new investors, you just issue those shares. So what it does is that you create, you give them an option. It's an option, not an obligation, right? An option for them to an option. Yeah, sorry about that. So what it does is gives you an option for the existing shareholders. It creates an option for them to come in to buy additional shares at a fixed rate. So what is interesting is that the current registration around that is the KAMA 1990, and I'm sure some of you already know that there's a new enactment, an amended one, the KAMA 2020, but it hasn't come into force yet. So it's coming to force in October, I believe. So why I'm saying this is because usually or typically under this KAMA 1990 regime, you can issue shareholder rights at a discount. So it gives the shareholders the right and the opportunity or the option to buy those shares at a discounted rate that as to the prevailing market share. But in the KAMA 2020, specifically Section 146, prohibits issuance of shares at a discount. And so you won't be able to issue them at a discount, but still you still have the option to issue shares to existing shareholders. And I'll move forward to warrants. So the option for warrants is it's kind of related to shareholder rights issue. So just imagine shareholder rights issue is to existing shareholders, but warrants is to someone who is not in the company yet. And so what it does is that it gives the warrant holder, in this case, the option to purchase shares at a fixed price within a stipulated period of time. So what this does, how it helps the company is that it allows the company to raise funds while the investor per se or the warrant holder is not even coming as a shareholder at the moment, but it has an option to come in as a shareholder in the future at a fixed price. Usually the fixed price is lower than, or be expected to be lower than the prevailing market rates. Because once it's higher than prevailing market rate, then it doesn't make sense any longer. And so the KAMA 1990 prohibits warrants, but interestingly, the 2020 is silent on it. And so that's why I added it to this. So probably effective from 1st October, companies will be able to issue warrants. Also talk about SAFE. That's a simple agreement for future equity. Is just a variant of warrants, just introduced by Y Combinator. I mean, that was an accelerator. They were the first to use the SAFE. And what the difference between the SAFE and warrants is that while the warrants allows you to issue shares, gives you the option of buying shares at a fixed price, right, in the future, or within a stipulated period of time. What the SAFE does is that it gives you that same option to buy shares, but the price is not fixed. So usually at a discount to what the prevailing market price is. So they could agree, the agreement to the SAFE would necessarily indicate the discounts that will be applied. You could say a 20% discount to the prevailing market share price in the future. And what this is that, okay, it's why Combinator introduces that it helps the startups to get investments without necessarily bringing the investor in as a shareholder until at a later point in time, which would be we refer to it as a trigger event where there's an insolvency or where there's a funding round where the company intends to get the funding so that's about the SAFE. So I'll talk about preference shares and then we'll move on. So preference shares, basically it's a type or class of shares. It's different from the ordinary shares. So investors find comfort in getting preference shares instead, because what it does is that it gives them the opportunity it gives them fixed dividends. So and it has priority over dividends accruable to other shareholders. So I'll explain for that. What it does basically is that as a preference shareholder, when dividends are being paid, you'll be paid first or paid before other shareholders who have ordinary shares, right? And secondly, what it does as well is that it's I wrote cumulative. Yeah, that means even fixed and cumulative dividends. So even where you don't pay the dividends in a particular area, maybe due to lack of funds, you still the investor can still get the fund, the dividends that were not paid in that year, in the next year. So it's cumulative, like it keeps accruing. And so under the new KAMA 2020 that's coming into force in October, it makes it mandatory for preference shares to be redeemable. that is the company or the founder must be able to redeem those shares. So how can you redeem the shares? Is by converting to ordinary shares or buying it back totally. Yeah, so let's go to the next slide. Yeah, so I'll just go into, because of time, I'll just go into the typical document that you will most likely sign as a lender, or sorry, as an investor or as a founder. And what I'll do now is I'll talk about 3 important clauses or 3 important considerations for this. And then from the investor's point of view and from the founder's point of view. But one thing I would like to add is that for all these options, where there's a change in your shareholding, where there's a change in your shareholding structure or the shareholders of the company, you have reporting obligations to the CAC, that's the Corporate Affairs Commission. And depending on the kind of option that is exercised, you might have to report to the SEC, that's the Securities and Exchange Commission. And there are rules guiding the CAC, which is the CAMA, and there are rules guiding the SEC, which is the Investment and Securities Act, ISA, and the SEC rules. So you might just have to talk to a lawyer, and I mean, they'll know their way around the obligations of these laws. So let's just go straight. The term sheet, I'm sure we all know term sheet. It's just an indication of the terms the parties would like to be bound by. So it's not binding. The Supreme Court has said it's not binding. But what it does is that it's like an indication, like, okay, this is what we want to do, this is what we want to get into. So it's just like a summary or a precursor to the main agreement, the definitive agreement. And so I'll just go straight to the share subscription agreement or the share purchase agreement. So the share purchase agreement would come into place where the shares being sold or being sold to the investors are shares being held by current shareholders, right? And so there has to be an agreement between those shareholders and the investors that are coming in. So that's a share purchase. So it's a purchase. But the subscription comes in where the shares are being issued or allotted directly to the investor by the company and not an existing shareholder. So they're just different terms, subscription and purchase. So the share subscription agreement, next slide. Yes, so like Tommy said earlier as well, there are concerns from the investor, right? He wants to be sure that everything about the company is true, everything is said about the company is true. So there's usually information asymmetry. What I mean by information asymmetry is that there is unequal balance. The founder has more information about the company, obviously, than the investor. So there's a need to try, of course, you can't make it equal, but there's a need to try and, as a founder, there's a need to try and give the investor confidence in terms of providing the necessary information to invest, because where there's little information, it affects the pre-money valuation of the company. And what I mean by pre-money valuation is that the valuation of the company before the investment comes in, and then post-money is after that funding round. That's the post-money valuation. So I'll just go straight to it. So how do you address the information asymmetry issues? And so typically, the founders issue disclosure letters. Disclosure letter is more or less like an overview of the company's obligations, outstanding obligations or existing obligations. Does the company have patents over its intellectual property? Does it have any rights over those intellectual property? Yes. If they have rights, are there outstanding third-party obligations linked to those patents and to the patents? And you're also looking at litigation exposure. Right? So litigation exposure in the sense that are there cases in courts already, or are there is there any sign that there will be cases in court, maybe a contingent that are sure that probably this will lead to litigation or a drawn out resolution proceedings? And so these are things that disclosure letter talk about. Where you are in the fintech space, do you have the right licenses, the appropriate licenses from the CBN? And so those are the things that we contain this disclosure letter. Basically, it's more or less saying, okay, this is where we are as a company, and this is what you are getting into. So I need to give you an idea of what you are getting into, and this is what you are getting into. And so that's a way of resolving this information asymmetry. And one other thing is giving warranties as the founder. So the founder will necessarily give guarantees. That's what the investors expect. Give guarantees as to the information you provided, that they are true and correct to the best of your knowledge. Where they are not correct, of course, there may be liabilities if the investor has suffered. So I'll try to go over it again. Where the investor has suffered because of a wrong information you provided, then where he has suffered loss, then necessarily you have recourse to the founder or to the company over those things. And so it's important to be sure that these warranties are robust, and as the founder, you are careful that the information you're providing is correct. And one thing you can do as the founder is to add knowledge qualifiers. So what the knowledge qualifier will do is to say, okay, where you have the information I've provided is true, but where you have access to a different piece of information and you add access to it, and you know that it's going to necessarily impact or have an effect on the viability of this company, and you still get into that, you still subscribe and go ahead, you won't have a recourse to me because you knew that information, you had that information already. Whether you discovered that information independently or through my disclosure, it doesn't matter. So that's the knowledge qualifier. And you have to be careful as the investor as well that knowledge qualifier is qualified in a way to say it's actual knowledge and not constructive knowledge. So I will explain. Constructive knowledge speaks to knowledge that you should know as a reasonable man, but not necessarily that you know. You may not even know other information, but you are expected to add that information. The actual knowledge is things that I actually know. It's hard to prove what is your actual knowledge, and because you always say, oh, I didn't know about this and all, but you just as the investor and as the founder, you need to be careful about the knowledge qualifier. Be sure the kind of knowledge that is being qualified, is it actual knowledge or constructive knowledge and all that. So I'll just move, because that leads us straight to the sandbagging provisions. And so we have pro-sandbagging provisions or anti-sandbagging provisions. So what the pro-sandbagging, the investor will naturally want to have a pro-sandbagging provision, because what it does is that it allows him to, I was talking about knowledge acquired independently, like outside what the company has provided already. So where he has his knowledge, what the pro-sandbagging clause does is that it protects him. It protects the investor in this case to say, and that he can still have recourse. Like I have the information that probably, okay, let me just break it down. Probably as a fintech company, my license is not, I don't have just a scenario now. I don't have the appropriate license, and the investor knows this, but the founder, I don't know. Possibly I don't know about that. And as the investor, he comes in and invests. And so that what that pro-sandbagging clause does, that the investor would still have recourse. He will still have recourse to the company for misleading him where there has been a loss as to the appropriateness of the license. So yes, he knew about it, but it wasn't disclosed by the company, and so he still has the right of recourse over it, and the company becomes liable. But as a founder of the company, you might want to kick back on that, and like I said, knowledge qualifier to say no. That once you acquire that information, whether it was disclosed by me or you acquired it independently, then you won't have recourse to it where there's a breach. And so quickly, I'll just go to sandbagging clauses. Just the last point on that. Sandbagging clauses are not. I've not seen the enforceability in Nigeria. I've not seen a Nigerian case that talks about sandbagging clauses and whether they are enforceable. Which are the pro sandbagging clauses? I'm not sure whether they're enforceable. There's no decision on that yet in Nigeria. Lastly, I'll talk about the anti-dilution, which is also important to the founders as well as the investors. And so the investor is concerned that, okay, I'm coming in, I have 30% shareholding, and in subsequent rounds of funding, that stake might be diluted when new shareholders come in. So necessarily, I'm looking at protections for myself as the investor, that my stake will not be diluted, or if it's diluted, it's not, the effect is minimal. And so that's where the anti-dilution clauses come in, the down-round protection. So what the down-round protection does is it gives the, for example, okay, where a case, two scenarios where there could be anti-dilution. Imagine the pre-money valuation, like I said before, the valuation of the company before the investment is $1 million. And then in different financing round, the company didn't do well and is valued at $500,000. So you see there's been a drop in the valuation of the company, right? And so the investor that came in at $1 million
will be asking, I came in at $1 million, buying shares at $1 million, but someone else will buy it at $500,000, which means it's buying shares that are cheaper than mine, and you necessarily probably have the power to purchase more and then dilute me in the company. One other scenario could be where the company issues new shares. So the company could have a 1 million share capital, that's 1 million shares, and in next financing round, so the company, the investor owns 30% of that, for example, and then the next financing round, to get more investors, more funding, he issues another 1 million shares. And so necessarily the person that had 30% of 1 million shares, in the next round will have 15%, right? 15% of the 2 million shares. And so that dilutes the investor. And so we'll be seeking protection for that. And so one solution is the full ratchet, or the another one will be the broad-based ratchet. Broad-based ratchet or the narrow-based ratchet, they are quite similar. And then you look at the full ratchet. So what the full ratchet does is that it allows the investor to come in at that new market price, that new share price. So you look at if he bought at $5 per share in the last round, and now it's at $3 per share. So it allows him to come in at $3 per share. So that means you'll be sending shares, or you'll be allotting fresh shares to the investor. But what it does is that it's the full ratchet. It depends on whether you're the investor or the founder. For the investor, you would want a full ratchet because there's no average. There's no average, so it allows you to come in at the new market share. But for the
Hello?
Founder, you're looking at the broad-based ratchet because an average will be done.
Hello? Sorry, Ayobami, I just wanted to jump in very quickly. Hello, Ayobami?
Yes, I can hear you.
Yeah, this is Salami. Sorry, I just wanted to jump in very quickly. For two reasons. Number one, and I'm so sorry to cut you. Two reasons. Number one, the time, and number two, the audience. I'm enjoying this, for example, because I've had to come across all of these various complex legal financing terms and conditions in the financing in the various terms of financing that we're about to sign in our business. But I'm just wondering, I don't know the composition of the audience, but I'm like, okay, if I'm hearing this as the first time founder, the law, you have confused me completely. I'm not even doing a game. I don't even want to do this financing something again. I'm just saying, and these are the intricacies of fundraising. But you said I should provide the founder's perspective, so I'm jumping in to provide that perspective. So, anyways, please carry on. But I'm just saying maybe we'll have to move this into a master class because this is like the core, the meat of legal when it comes to financing.
Okay, so thank you for that. I understand that
maybe
the audience...
questions from the audience might help then put in some clarity on this so that we also, can ensure we catch it on time.
All right, thank you. So I just wanted to touch on those clauses actually on the surface and not go too deep. And so thank you for that. Thank you for that reminder. And so, so I've discussed the anti-direction, information asymmetry, and summary clauses. These are just some of the clauses that you necessarily come across, and from the founder's perspective or the investor perspective, there are some things you might insist on or push back on and all that. And so, next slide. Is there anything else? Yeah, I think that should be all. Yes, so that will be the end. Thank you.
Thank you very much, AY. And just because of time, we just have one last thing up. So we'll be calling on Seyi Kolawale. He's an analyst at NASD, and he'll just be running us through very briefly OTC options for our audience. So it's just a form of introduction. Thank you very much, Seyi, and you have about 5 minutes.
Thank you very much. It's a pleasure to be here, and I'm very happy to speak to this. The panelists who have gone before me, I think, have said everything that really needs to be said. What I am really here to do is then very quickly run through what NASD does and the opportunity it affords fintech companies, companies in technology space, and those in the financing space as well. Next slide, please. So what do we do? NASD, next please, is an exchange, a securities exchange. I'm sure you're familiar with the Nigerian Stock Exchange, FMDQ. We are a similar exchange that deal in equities. Next slide, please. We were founded a long time ago. We were an association in the 90s. But now we have received a license to run as a full exchange. Our mission is to be the hub of first call for capital formation in West Africa. And our mission essentially is to create liquidity transparently. Next slide, please. So I would, next please. I would skip through a lot of these slides considering the time we have available and just go to the meat of it. Okay. So we essentially have we cater to two aspects of the market, the secondary and the primary. The secondary in the sense that for public companies that are already, companies that have already gone public and have their shares in the hands of shareholders, we provide them an opportunity, a platform for them to trade their shares. A number of these companies are not listed on any other exchange, and it's illegal really for the shareholders to trade these shares outside of a registered exchange. So we provide that platform for them to, carry out secondary trades. The primary market, on the other hand, is the NASD Enterprise Portal. Essentially, what it does is it caters to private companies that are also looking to raise funds. A lot has been said about the funding avenues and opportunities available to tech companies and companies that are just starting off. Frankly, it comes down to the entrepreneur making a decision for himself. You might as well, start with family and friends. You might then go on to bootstrap, and you might then go the venture capital route. However, they all have their advantages and disadvantages. I think what the panelists who have gone ahead of me have done is they've, come to help you realize the positives and the negatives. Essentially, what we do is we provide the avenue for you, having sat down and, counted your options and you've decided to go a certain route. What we then do is we help you actualize that route. We pretty much handhold you. Next slide, please. Next, please. Okay, next. Yeah, so we admit companies in two processes really. You can either come in as a security admission or a company admission. For security admission, that's majorly for public companies who have their shares in the hands of shareholders. The shareholders can then come into us and list that company. A company admission where the company itself then comes in and looks to list its entire shareholding on our platform. Next, please. Next. Right, so this is just a broad overview of securities, or do I say companies that are currently listed on our platform across various sectors, from financial services to the FMCGs to the industrials, the oil and tech. In tech technologies, MT. We're looking to the number of companies as well on the platform. Some are new, quite popular, some not so popular. But the whole idea is to help them, access funding and also create liquidity for the ones that are already public and their shareholders need to trade. Next, please. Next. These graphs just show our market performance, but for time, I'll skip through that. Next, please. Next, please. Next. Okay, next. Okay, this talks about the primary market next. Essentially, what we do is we prepare you with a DDA, due diligence advisor, who then helps prepare your books. And these DDAs have an idea what investors are looking for, really. Like I said, if you made your mind up and you want to go the investor routes, we're talking about venture capitals, private equity firms that might be very interested in investing in your business. So the due diligence advisors pretty much handhold you through the process, help you prepare your books. We typically look at companies that have been around for 2 years at least, and show responsible accounting, have books of accounts. That's a starting point for us before we then go on to see what type of investors are interested in you. Next, please. Well, the NASDAQ community is pretty much made up of enterprises like yourselves, of all ages and sizes, the diligence analysts, like I said, accredited investors from not just Nigeria, but from all over, actually, who are looking at West Africa as a potential investment point. We also work with incubators. Our incubators are responsible for, building up the companies, providing essential services. Work with the likes of associations, Tunelumelu foundations, some other foundations in Nigeria as well, CC Hub, for instance, who help populate the platform. Next, please. Next, please. Right, these are just those who have partnered with us, some of the portal feeders. We call them feeders because they help populate the platform with companies who have maybe gone through, their induction program or, entrepreneurial program. We work with Face Foundation. We work with the LCCI, the Manufacturers Association of Nigeria, Bank of Industry. More recently, we signed an agreement with the Fintech Association of Nigeria as well. The whole idea is for them to, also have some of their fintech companies who are seeking essential funding to come on the platform. Next slide, please. Some of the existing players we also have, these are also partners. These are some of the larger names. We also have smaller firms. We have Deloitte, Udodoma, Bridgestone, PwC. Essentially, their role is to, assist enterprises. They have an understanding what investors are looking for. And essentially, they help companies prepare their books, handhold them essentially through the process to ensure they have a seamless experience on the platform. So essentially what NASDAQ does is work for private companies who are looking to, like I said, there's an age limit, obviously. You must at least have been in business for 2 years before you can then access the kind of funding we're talking about. And responsible accounting is very important as well. Next slide, please. I think that's about it. Okay, this just talks about eligibility requirements of investors. We try to ensure that investors we work with are those who are reliable. The major challenge we encountered, or we have been encountering in Nigeria, is a lot of entrepreneurs are not willing to part with their businesses. And there's a reason why, obviously, at the same time, there's a reason why they should, because of sustenance of operations. And, you want your business to outlive you. Well, some people want their business to outlive you. So one of the reasons, why it might be a good idea to partner with investors is also that. But yeah, like I said, there are different options and alternatives. You can do family and friends funding. You can do public equity funding. More recently, we launched our crowdfunding platform. There has not been a lot of that in Nigeria, even West Africa as a whole. We're waiting for the Securities and Exchange Commission of Nigeria to finalize the rules on that. But that's also an avenue for enterprises and startups to, raise funds. Obviously, there's pros and cons, like I said, but in the event that, you've sat down and count the cost of the decision you're willing to make, then NASD is a good place, a reliable place, I would say, to help raise these funds and create liquidity for shareholders. I think that's about it. And thank you very much, Chinonye. I would hand over to you now.
Thank you very much for that. So we'll just quickly be going into a question and answer segment. Because of time, we'll only be able to take just a few questions. So I can see that there are 2 questions on the Q&A box, and they seem to be for AY. So Ayobami. So if you can just answer these questions in about 1 minute, 2 minutes, and then we'll take 1 question from our Instagram, or if we get any other questions. So the first question is from Vivian, and she says, in light of the changes in the CAMA 2020 on automatic application of primitive rights during share offer, what would you say is the future for a deed or share charge?
So thank you for that question, Vivian. So I believe you meant preemptive rights, because I'm looking at the question now, not primitive, probably it's a typo. So I'll just assume it's preemptive rights. So like I said during the presentation, preemptive rights give the existing shareholders an option of first refusal. Okay, you've confirmed. Okay, preemptive right here. So it gives the existing shareholders an option of first refusal over issuance of shares in the future. And so that means they necessarily can either accept or refuse to buy those shares before they are offered to other people, like third parties. And so basically, what does the CAMA 2020 say about it? I think it's section 21 or 22. It says that companies would have preemptive rights in their articles of association, but it's not compulsory because there's a use of a word may. So it means that it's still optional depending on what the company wants. But so I don't feel it has any material change. When the company accepts the preemptive rights to be in its articles of association, then it's not actually affect the deed of share charge in terms of enforcement. So before, there must have been a waiver by the parties, by the existing shareholders of those rights, or those waiver rights. There must have been a waiver of those rights rather before you can enforce the deed of share charge. So I'll go to the second question. On SAFE, how is the investor protected considering the discount agreed on for purchase of shares at the prevailing market rate may exceed its profits? Yeah, so okay. And so it's an option, right? The SAFE gives an option for you to come in at a later time at a discount. So it's not compulsory for you to come. It's not mandatory or obligatory. It's just an option for you to come in. It could exercise that option as the holder of the SAFE or not. But that doesn't disturb the interest that you necessarily get from the investment you made initially. But what it just does is that it gives you an option, additional option to come in as a shareholder at the future time. So where the price of those shares are so high that it will make sense to come in talking about business, then it's just an option, it's not mandatory. So I think, yeah. So there's a third question that just came in. Okay, for Tommy, all right.
So we have a question for Mr. Tommy here. So it says, considering your experience, at what points do you think a company can switch to debt financing?
Well, like I said before, it depends on your cash flow and the amount on your ability to pay back on those loans. So at the early stage of your business, as you're evolving, you might not want to put that amount of pressure and on your cash flow. And it also depends on the cost of debt. So I'll say look at your books and also what you want to use the financing for. So at the early stage of your business, I would strongly recommend that you go the conventional route, look for seed funding, cheap, patient capital. And as your cash flow improves, then you can now start to look at debt finance, unless it's cheap, long-term funding.
Thank you very much. So due to time, we won't be able to take all the questions. We have a couple of questions on our Instagram. So what we'll do is to collate the questions and see if our facilitators would be gracious enough to answer them and we'll circulate. Also for the questions regarding the slides and the recording, it will be available on YouTube and we'll circulate via email in due time. So John,
Chinonye,
yes.
Sorry,
yes,
before we go off, I wanted to add something to what what Tommy just said. And I think it boils down to what I said before, in the sense that, again, the presentation today has been awesome, absolute quality. I've learned a lot myself, everything from the legal part. I'm looking forward to the presentation, actually. Please, I beg, I love all the decks that was presented. But my point specifically is as regards, for example, when you seek debt financing or where do you seek equity financing, I think there's less. So it's like asking, when do I buy a car without knowing what do you need a car for? So the point is that you need to, like, every business needs to first define the type of business that it is. For example, I'm sure Tommy's answer was specifically relating to maybe a venture funded business. If, for example, you were doing a business that was into trading and you need debt capital upfront because you need to buy inventory that you turn around in 15, 30, 45 days, you absolutely can go for debt. And I'm sure Tommy will tell you how that is, for example, possible. So that's why I want to reemphasize the point that every business needs to Like there's the quality of the presenters, the facilitators today was absolutely, like, you literally need to put this into some sort of master class, because if everybody has this level of mastery of their business, some of these questions becomes easier to answer.
Yes.
So that mastery of your business, I think, is even more fundamental and more important to, before you then decide what type of financing do I need, from where and how. I just wanted to add that, and definitely the NASD is a new information for me, so I'll definitely be looking forward to connect with on that. Please, back
Thank
to
you
you.
very much, Mr. Salami. So thank you so much. I mean, we could go on and on, like you said. This could literally be a masterclass, but we need to respect time, and we've gone far over time. So thank you very much to everyone. Like we said, we'll still answer the questions and circulate them as we usually do. And just to anticipate our September's webinars, we'll be having two. The first one is essentially on imperatives and framework for building a successful payment process, and also on big data and cloud computing, emerging opportunities and challenges. So we hope that you look forward to that, and we'll be sending the information on that in due course. So thank you very much for attending, and we all hope that you have a lovely day. Thank you very much once again to our facilitators and also to the attendees.
Thank you, guys.